Taxation of partnerships, advanced taxation. In this video, we are going to study taxation of business income and specialized business activities, and we will look at admission of a new partner and retiring partners during the year, conversion of a partnership into a liability companies, then incomplete records pertaining to partnership businesses, and case law on taxation of partnership businesses. My name is Mr. William. So we can give a general overview of what we are expected to see in this discussion. Now, the concept of taxing a partnership is just like any other business, because any business must have expenses as well as incomes. So, in financial accounting as well as financial reporting, at this level, you should be very conversant with how to tax, not taxing, but with how to prepare the accounting profit. You should be able to prepare the accounting profit, and you understand that whenever you are preparing accounting profit, you get your sales, you minus the cost of sales, then you less all expenses. Now, you can be having some incomes because when preparing the income statement, once you get your gross profit, you usually earn other incomes, all other incomes, and then you less all the expenses based on accrual basis. And so in this case, you'll be earning maybe the accrued figures, and you are less in prepaid figures, and then all that. Then finally, you get your accounting profit or your profit. Now, this accounting profit is very different from taxable profit, because what we are doing here is taxation, how we tax a business, any business. But here specifically, we want to look at how we're supposed to tax a partnership. Now, before we move on with the discussion, it is very important to know that as far as taxation is concerned, we should know how to tax an individual, how to tax a partnership, and how to tax a company. What makes the major difference here when we are taxing a company or a partnership or maybe an individual? Now, in this case, companies usually are classified as artificial persons which are supposed to pay corporation tax here in Kenya at that percent. So usually companies pay corporate tax, different from individuals. Individuals do not pay corporate tax. What we do is that we get the different sources of income from individual, and then by the end of your calculation, you subject those amounts into graduated scale rate. The same applies to partnerships. So usually, you calculate different incomes for a partnership, maybe from business. Then, by the end of your calculations, the partnership may be having a profit or loss. You share that among the partners. And then once you share that, that profit share is a source of income to that particular partner. So if you assume that the only source of income for this particular partner is the profit share, then you subject that particular profit share into tax. You just follow the same process that you follow when taxing an individual. So you follow the graduated scale rate. I believe you know how to tax individual. So you can be having a partnership business where there is a profit share, and then there are other sources of income for these partners. So aggregate the other sources of income to that particular partner together with a profit share, and then you subject the same to graduated, scale rate, and then things like pay as you earn, things like personal relief, and such other kind of things that you do when taxing individual will be applied the same way. So here note that even though in partnership, these are partners who are trading together, then our taxation concept will not be the same as that we follow when taxing a company. Now, this chapter, which is chapter 1 in advanced taxation, is to do with taxation of a partnership business. How do we tax a partnership business? That's a starting point. I want to start by reminding you that we should have the knowledge of expenses and incomes. One, expenses can either be allowable or disallowable. Incomes can be taxable incomes or non-taxable incomes. Now, if you want to understand taxation of businesses very well, whether it is a sole trader, whether it is a partnership, whether it is a company, any form of a business, the basic thing for you, the fundamental thing to do, the most basic thing for you to know, if you want to be very comfortable with taxing businesses, is first knowing what are the allowable expenses and what are the disallowable expenses. Have a list of it according to the Income Tax Act. What are the allowable expenses and what are the disallowable expenses? Have a list of it. And then number two, what are the taxable incomes and what are the non-taxable incomes? Once you know that, then you can attempt any question and you can tax any business in real life situations. Now, I am started by telling you that if you know how to prepare the income statement from financial accounting or financial reporting perspective, then when it comes to taxation, you just need to know out of all the expenses that I normally use to prepare the income statement, which ones are allowable, that is, uh, which ones are allowable and which ones are disallowable. Then expenses, that is, the incomes, which incomes are taxable and which incomes are non-taxable. Once you know that, then you can attempt any question. Now, the other thing that you should know about taxation of partnerships is how to prepare the partnership distribution schedule. Very important. So basically, those are two things or three which you are supposed to be very conversant with. If you want to tax any partnership, make sure you start by knowing expenses which are business expenses which are uh, that are disallowable and those ones which are allowable and those ones which are disallowable. And then incomes which are taxable and which ones are not taxable. That's the first thing. The number two, understand how to prepare the partnership distribution schedule. Those are two important things for you to know. Now, the other important thing is knowing there are two methods that you usually use when you want to know the taxable income or the taxable profit of a partnership. One, or in business, one is a direct method, and the other one is indirect method. Now, those are important points for you to note. Now, let me give you some analysis here about the format that you should be using. Now, the indirect method, if you look at the analysis that I've tried to give here, the indirect method for taxation, reported accounting profit. Now, this is indirect method, meaning that you have, as an accountant, you have prepared the income statement and you started with your sales, you deducted cost of sales, you got your gross profit and all other incomes, then you less all the expenses, you got the accounting profit by the end of the day. So that accounting profit which you have is not the amount that we are supposed to tax. For the purpose of taxation, we don't tax the accounting profit. So the accountant has prepared the income statement whereby he has considered all the incomes as well as all the expenses. Now, for the purpose of tax, we are supposed to take the reported accounting profit, then we earn back all the disallowable expenses, earn back all of them. Because these are expenses which should be taxed. The accountant deducted all the expenses, regardless of whether they are taxable or not, all of them. So, but the Commissioner for Domestic Taxes, or simply the taxman, is telling you that even though you have deducted all the expenses, there are some which should be taxed. So you get your reported accounting profit, then we earn back the expenses which are disallowable. A good example is depreciation, for example. Depreciation is a disallowable expense. In preparing the income statement, we usually less the depreciation. But for the purpose of tax, we are supposed to earn back all the depreciation and then you claim for wear and tear, which is supposed to be a uniform figure for all the businesses. So that's an example. Now, once you have earned back all the disallowable expenses, so we are saying if you are using the indirect method, already you have been given the accounting profit, meaning that profit where you have earned all the incomes, you have deducted all the expenses. So we earned back, you earned back any disallowable expenses. You have some examples here, but not what I've told you. You should have a list of all the disallowable expenses and all the allowable expenses. So you less all of them. Once you not lessing you earned all of them, then you less any. This point here is critical for you. You less any taxable. So remember you said you earned back all the disallowable expenses, the first step. Then once you've done that, you less any non-taxable non-business income. This income, the accountant considered all the incomes. So we are saying, but there are those incomes which are non-taxable. So obviously, we are supposed to less them. Is an income which was part of the accounting profit, but it's not supposed to be taxed. So we less it. This point here, we less them. We also less allowable expenses not charged, like investment allowance. As I've told you with depreciation, we usually less depreciation, but you're supposed to earn back the depreciation you claim for wear and tear. So that wear and tear is the one that you claim. Those are capital allowances or capital deductions, like investment deductions and others. Now, once you less uh, all the allowable expenses not charged, like investment allowances, things like trading loss, balancing charge, then you earn other taxable incomes like rental income, farming income, non-qualifying income, then you get your total taxable income. So basically, that is how you prepare uh, the total taxable income for a partnership using the indirect method. Now, this is the simplest way. This is the simplest one because if you are given the accounting profit, that is as it appears in the income statement, you just need to pick the accounting profit reported, then you earn back all the disallowable expenses, as I have told you here. Now, the other part is that's the other way, the other method that you use to calculate the total taxable income is the direct method. This one, usually, we advise that you should be very conversant with incomplete records. Incomplete records. You must be very conversant with incomplete records. Otherwise, you'll not be able to tackle a question whereby you are required to use the direct method. Now here, be able to prepare the debtors control account as well as the creditors control account. Now here, the debtors control account will give you the, the sales, debtors will give you the sales figure, and then the creditors, you get the creditors control account, you get the purchases figure. You need them here, the sales. If you prepare, now before I explain to you what is happening here in the direct method, you should come here and see incomplete records, for example, debtors control account. And again, the concept that you have done in financial accounting should also be useful, whereby we say that all assets have debit balance, increase in assets, you debit, decrease in assets, you credit. Then all the liabilities have a credit balance, increase in liabilities, you credit, and the decrease in liabilities, you debit. That's important. Because when you are dealing with debtors, a debtor or receivable, this is an asset. So you start by bringing the balance brought forward here on the debit side, the opening balance. The examiner may give you cash sales as well as cash sales, for example, and then so you take the balance brought forward on this side, that will be given the opening balance. Then credit sales will be on that side because anything that is increasing, the opening balance should be on the debit side. Anything to reduce the debtors should be on the credit side, like cash from debtors, bad debts written off, discount allowed, sales returns, then balance carried down, the closing balance. The examiner most of the times will give the balance carried down and the opening balance. So to prepare the debtors control account, the examiner should give you what was my opening balance and what was my closing balance. And then maybe the credit sales will be given, the bad debts, anything to reduce the debtors will be on the credit side. And then the balancing figure, you find it from there. So the balancing figure is on the debit side, and therefore that may imply what? That may imply the credit sales, those sales which were made on credit. So if you are given cash sales as well, cash sales, and then your debtors control account, the balancing figure which you get here on the debit side, so your total sales will be cash sales as given plus this balancing figure here, the credit sales. Then you add the two, you have your figure here. That's what we are saying. So you see, it's incomplete record. We may be given the cash sales, but we don't know what was the total sales which were made on credit. Remember, in financial accounting, we usually say that in presenting financial information, we usually apply the accrual concept. Sales, whether they were made on credit or on cash basis, we should combine both of them, even for the purpose of tax. Combine both of them. So here, the sales will be comprised of cash and credit. Cash and credit sales. So if you are given cash sales, then you should get the credit sales from your debtors control account. You combine the two, you report that figure there. Cost of sales. We know what cost of sales is. Opening stock plus purchases minus closing stock. In most of these questions, you find you are given opening stock and closing stock. You may ask, where will I use these ones? It's for the purpose of calculating the cost of sales. Opening stock. Now, purchases is the one which may require you to prepare this control account. Purchases, you prepare creditors control account. These are liabilities. You'll be given opening balance. Balance brought forward is on the credit side, and the balance carried down is on the debit side. anything to increase the creditors should come on the credit side, and anything to reduce the creditors should come on the debit side. So, cash paid to the creditors. If you pay the creditors, the figure is reducing. So, you bring it on the debit side. Discount received, it reduces the creditors. Purchases returned, it reduces the creditors. And then the balancing figure now, once you tackle that, because the opening balance will be given, the closing balance will be given, any transaction that is reducing the creditors comes on the debit side. And any transaction increasing the creditors will be on the credit side. Mostly, the balancing figure, the balancing figure will be the credit purchases. And that's a figure which you use if you're given the cash purchases, you plus the credit purchases. So that when calculating your cost of sales, this figure here, what is the cost of sales? You take opening stock plus purchases, which comprises of cash purchases and credit purchases, then you minus the closing stock. The stocks will be given. So you have your cost of sales. So the sales you have, you less cost of sales, you get your gross profit. Now once you get your gross profit, remember this is direct method. If I have my gross profit, I will only need to earn taxable business income. Only earn taxable business income. Any business income which is taxable. And I started by telling you that for you to be conversant with the taxation of any business, read Income Tax Act or from your notes. I will give you the notes later, which explains or gives a list of about 50 or 40 items which are expenses which are uh, allowable and the ones which are disallowable, incomes which are taxable, and incomes which are untaxable. That's the most important thing for you to do. So that when you come here, when we say you have calculated your gross profit, remember in most of the cases, in taxation, especially at this level, they will always ask you a question which is concerned with incomplete records because they want you to be very conversant with those situations where you do not have complete records. Some records are missing. So here, once you get your gross profit, get any incomes, any business incomes, which are untaxable business incomes. Those incomes which you have received as a business and they are taxable. And they are taxable. You earn them. Then the next thing that you do to your gross profit is you less all allowable expenses. Expenses which are allowable. Expenses which should not be taxed. So that when you less the allowable expenses alone, you are left with disallowable expenses. That's the reason. You can see the difference here with the first method, indirect method. Because this one, with the indirect method, you are dealing with that profit or loss which was prepared by the accountant. The accountant deducted all the incomes and then he deducted all the expenses. So we are saying with our reported profit and mark disallowable expenses. And then the process continues. Different from this with the direct method, whereby you are the one now to calculate your sales, you less your cost of sales, and then you proceed with earning taxable business income, and you less allowable expenses, so that you get your taxable business profit. Your taxable business profit. Then we earn other taxable incomes like rental income, farming income, and non-qualifying income, any other taxable business income, so that you get the total taxable income. So that is what you are supposed to do as far as this chapter is concerned. So the most important thing, I remind you again, because that is the most important thing, once you understand, once you classify expenses as those which are uh, expenses which are allowable and those which are disallowable, and incomes which are taxable and incomes which are non-taxable, then the rest becomes very easy for you. But if you are not able to know which expenses are taxable, which ones are allowable, disallowable, and all that, you may get mixed up. But I'll tell you more about that as we proceed with the discussion. So once you have known that, the other is be conversant with preparation of incomplete records and then how to prepare the partners distribution schedule. Now, because we are doing chapter 1 of advanced taxation, and chapter 1 is dealing with partnership business, how to deal with partnership. Now, what we should, because now we'll be moving to calculations, but I remind you to be conversant with what we are doing here today. What you'll be moving on with when you go to a calculation is admission of a new partner and retiring partners during the year. In these situations, you may have a partnership which is started in January or it was operational from January to June. Then in June, maybe there were two partners from January. In June, they added one more partner, so they are three. So what are we supposed to do in that case? So in preparing the books of accounts, we should apportion this 1 year into two parts. One part should comprise of two partners who were operating. Then from June to December, you'll be having three partners. So we should show the performance of this business from January to June when we were operating as two partners. Show the performance for the first 6 months, then the performance for the next last 3 months from June to December when there were three partners. That's what we're supposed to do. That is admission of a new partner and retiring partners during the year. So when the partner retires, we should show the performance of this business up to the date of retirement and then performance of the partnership from that date of retirement up to the end of the year. The same applies to retiring partner. When a partner retires, show the performance before the retirement and after retirement. Apportion that year appropriately or accordingly. So you'll be preparing some questions which are dealing with taxation of a partnership where there was admission of a new partner or retirement of a partner during the year. We take that as an example. Another thing which is important in chapter 1 is conversion of partnerships into liability companies. So we'll be facing situations where a partnership operated from January maybe to October as a partnership. But from October to December, it was converted into a company. So how do we prepare the books of accounts for this sort of a business for the purpose of tax? You can see for the first 10 years, for the first 10 months, this was a partnership. But the remaining 3 months, it was a company. So you have to apportion that particular business into two periods. First 10 months, partnership, and then the last 3 months, it was a company. So we'll be dealing with such kind of questions. And then the other thing is incomplete records pertaining to partnership businesses. You'll be coming across many questions whereby we are taxing a partnership, but we are dealing with incomplete records. That's very important. So in summary, what we will be dealing with in chapter 1 is first, you have to know a list of all expenses which are allowable and the ones which are disallowable. And number 2, incomes which are taxable and incomes which are non-taxable. That's one thing. Then how to prepare the partnership distribution schedule. Very important. So that is something that I wanted to introduce you today. So this taxation, I think chapter 1, I'll just take 3 lessons and then we'll move to chapter 2. So you can just look at Just try to look at what is on the board. Let me stop blocking you. I stop blocking you. You can see what is on the board. I don't know whether you are able to see. I don't know, see whether you are able. Are you able to see what's on the board? I don't know whether you have. Well, there's a lot of light. If you can see that, I think there is no too much of light. I think there is a lot of light. I'm sorry for that. But let me allow you to see from that side. Let me allow you to see from that side as, as I just mentioned something about disallowable expenses. I told you to go through disallowable expenses. What are disallowable? What are disallowable expenses? Disallowable expenses are the expenses that, when computing taxable profits, they should not be deducted. They should not be deducted. Now that point makes sense when we are using the, which method is that? It makes sense when we are using this indirect method. The direct, that is. We are saying disallowable expenses should not be, disallowable expenses, disallowable expenses should not be deducted. It means when you are, if for example here you say get your sales, less cost of sales, you get gross profit, you earn taxable business income, less allowable expenses, less allowable expenses. So if you less allowable expenses, you are only left with disallowable expenses there. You can see here. They should not be deducted. And if you come to indirect method, you can see the accountant deducted all expenses, whether allowable or disallowable. And we say they should be added back. We are saying disallowable expenses are those expenses which should not be deducted. They should not be deducted. So I have explained to you what are disallowable expenses. They should not be deducted. That is why if you're using direct method, we are saying you only less allowable expenses. Now, allowable expenses should be deducted because they're expenses that a business may incur expenses to generate the profit which is being taxed. So you cannot tax an expense which was incurred by the business to generate that profit which you are taxing. For example, salaries and wages to employees, electricity, water, transport, fuel, any expense that the business is incurring to generate the profit being taxed should be allowed. The opposite is true. If you incur an expense and that expense is not generating the profit that is being taxed, then that expense should be disallowable. That's the meaning that when we say that disallowable expenses are those expenses which should, or are expenses that when computing taxable profits, they should not be deducted. They are disallowable. They should. They should not be. They should not be deducted. They should not be deducted. So these expenditures are not wholly and exclusively incurred in the production of taxable income, thus they must be taxed. Some examples are, now I'll give you some examples of disallowable expenses. I'll give you some examples of disallowable expenses. Now one one is one example is unrealized foreign exchange loss. Another is loss on sale of shares, loss on disposal of non-current assets. So I'm just giving you some examples of disallowable expenses. You say unrealized foreign exchange loss, loss on sale of shares, loss on disposal of non-current assets, expenditure or cost of acquiring non-current assets, penalties, fines, and taxes, and all expenses relating to taxes, e.g., cost of tax appeal. Expenses that are of private nature, i.e., they are not related to the business. General bad debts, increase in provision, that is, increase in general provision for bad debts. Losses incurred by a business which is not carried on with a view of making profit, e.g., losses from orbit farming. Penalties and fines incurred for the breach of the law. Or capital losses, e.g., loss on sale of a fixed asset or shares. Amount of expenditure or loss recoverable under the insurance contract or indemnity. Depreciation, diminution, amortization of goodwill, assets written off, or amounts of capital expenditure loss, conveyance fees, or amounts of personal expenditure incurred by an individual in the maintenance of himself, his family, or for domestic purposes. Amount of premium paid under an annuity contract. The amount of expenditure in the production of income by a non-resident person with no permanent establishment in Kenya. So those are some examples of disallowable expenses. I've told you that expenses which are disallowable, those expenses should be taxed. They should always be included for the purpose of taxation. Now, and I've told you that there are expenses which they are not helping to generate the profit which is being taxed. Like, for example, what we have given above. Now, bad debts is very important concept for you to understand because bad debts can either be specific or general. We should be able to know which part of bad debts is taxable and which one is not taxable. Now, if it's specific bad debts written off, that is an allowable expense. General bad debts written off, that is disallowable expense. Specific bad debts written off, the general bad debts written off recovered. Okay, I think, so general bad debts written off but recovered, that's a non-taxable income. Reduction in provision for specific bad debts, that's a taxable income. Then reduction in provision for general bad debts, non-taxable income. Increase in provision for specific bad debts, that's allowable expense. Again, you note that wear and tear allowances replaces depreciation. You have said that depreciation is a disallowable expense. You should earn back the depreciation, then you claim for wear and tear allowance. Now, there are certain terms that you find in taxation which you may need to know the meaning. That is trading receipts, balancing charge, trading loss, and balancing deduction. Now, trading receipt is, what does trading receipt mean? Trading receipts If all the assets of a given class of wear and tear are sold at a price higher than the written down value, the profit is known as the trading receipt. It is a taxable profit. So you know that trading receipt is a taxable profit. I've given you the meaning of a trading receipt. Then balancing charge, what is it? If all the assets of a given class of wear and tear are sold at a price higher than the written down value and the business is ceasing to operate, this profit is known as the balancing charge. It is a taxable income. So with the balancing charge, the business is not a going concern. We are selling, or it is the asset of a given class of wear and tear are sold at a price which is higher than the written down value. But this business is not a going concern. It is closing down. So it is a taxable income. What's trading loss? If all the assets of a given class of wear and tear are sold at a price lower than the written down value, and the business is continuing to operate, the loss is known as the trading loss. It is an allowable expense. So for trading loss, the business is a going concern. It is not closing down. Balancing deduction. If all the assets of a given class of wear and tear are sold at a price lower than the written down value and the business is ceasing its operations, this loss is known as the balancing deduction. It is an allowable expense. So I've given you some disallowable expenses. That expenses that when computing the taxable profits, they should not be deducted. Now let me give you some allowable expenses. And I have told you, if you want to know what allowable expenses are, we ask yourself whether this expense is helping you to generate the profit which is being taxed. If an expense is helping you to generate the profit which is being taxed, then that expense should be allowable. We should not tax it. Again, allowable expenses, the government wants to encourage you to incur that expense. Therefore, but if you want to discourage a taxpayer from incurring a certain expense, then that becomes disallowable expense. Like for example, breach of law. If you break the law, if there are fines and penalties, you don't pay your tax and then you are taken to the court of law, you are penalized, then that expense is disallowable because the government is not encouraged, should not be encouraging you to be breaking the law. So allowable expenses are those expenses that from the perspective of the commissioner, they should be deducted when computing taxable profit. According to the Income Tax Act, they are the expenses which are wholly or exclusively incurred in the production of taxable income. For instance, the wages and salaries is what you pay the employees so as to make sales and other operational activities. We cannot therefore tax salaries and wages because it is an expense that generates the taxable income. Otherwise, we will be discouraging the business from generating what the government should tax. The allowable expenses or allowable deductions include expenses that are only or exclusively incurred in generation of taxable incomes, e.g., rent, electricity, salaries to the employees, etc. So any expense that the business incurs, and this expense is helping the business to generate profit, that expense should be allowable. It should not be taxed. You have given examples. However, because what you are doing in chapter 1 is taxation of a partnership, note that for salaries, salaries to the partners are disallowable. Disallowable. But salaries to employees are allowable. So you note that. You check that when you are preparing the partner's distribution schedule. So allowable expenses, you have said expenses that are exclusively incurred in generation of taxable incomes, e.g. rent, electricity, salaries to the employees, etc. Contributions by the employer on behalf of the employee to NSSF, NHIF, or SHA, and contributions which the employer makes on behalf of the employees to the National Social Security Fund. Expenditure on advertising. But important thing to note here, if you are advertising, it includes expenditure intended to advertise or promote directly or indirectly the sale of goods and services provided by a given business. For instance, advertisement on the TV, radio, press, calendars, sports like football clubs, golf tournament, rally cars, horses, etc. Note that advertisements in the form of passengers shades at bus stops, neon signs, billboards, and signboards are capital expenditure and not allowable. But the expenditure qualifies for wear and tear allowance. So here, if you make advertisement of your business through TV or radio, then that is allowable. But if you are doing it through maybe the billboards, then that becomes disallowed. Another expense which is allowable is discount allowed, contributions to professional bodies like ISPAC or Law Society of Kenya, club subscriptions for use by the employees, donations to registered charitable institutions like Red Cross or AMREF, cost of scientific research incurred for business purposes, whether capital or revenue in nature, amount of contributions to a scientific research association which undertakes research related to the class of business of the contributor, amount of contributions to a university or college or research institution approved by Commissioner for Domestic Taxes, e.g. AMREF, KEMRI, ICPE, etc. Specific budgets, increase in specific provision for budgets, realized foreign exchange loss, trading loss, balancing deductions, expenditure that is capital in nature incurred in farming, such as construction of gabions and digging of terraces, cost of uprooting, clearing and planting permanent and semi-permanent crops, legal fees and stamp duty incurred when signing a lease agreement of 99 years or less, cost of listing a company in the stock market, cost incurred in the issue of shares, defending business property costs, entrance fees, and annual subscription fees paid to professional bodies and trade associations, acquisition of a lease of 99 years and less, expenditure on advertisement and sales promotions, interest paid on loans taken to generate business income, mortgage interest, losses brought forward from the previous period, but they must be in the same business line, pre-trading expenses provided that such expenses will be allowable if incurred after the commencement of the business, expenditure on legal costs and stamp duty in connection with defending of business property rights, other business-related litigation such as settling of business disputes, legal costs and other expenditure including capital expenses related to the issue of shares, debentures, or similar securities offered for purchase to the general public. We have a list of, as I told you that when you are studying taxation of any business, then be familiar with expenses which are taxable, allowable, and the ones which are disallowable. Now, something else that I can mention is to do with the legal cost, because the notes that are the allowable expenses and disallowable expenses that I have read for you right now, I believe you should have them somewhere. There are many, but you should understand why they are classified the way they are classified. Now, legal costs, most of the times, they will give you legal costs which are allowable. Now, the following legal costs are allowable. One, legal costs incurred in collection of bad debts. The following legal costs are allowable. One, legal costs incurred in collection of bad debts. Number two, legal cost in respect to successful defense of a breach of contract. Number three is legal cost in respect to preparation of staff contract when recruiting new employees. Number four is legal cost in respect to preparation of a lease contract which does not exceed 99 years. So those legal costs are allowable. The following legal costs are disallowable. Legal costs in relation to capital items purchased or transferred, e.g., stamp duty, conveyance fees, etc. Legal cost in defense against criminal cases. Legal cost in preparation of lease agreement of more than 99 years. Legal cost for preparing of memorandum of association or partnership deed. Legal cost in preparation of trade agreements. Legal cost in respect to obtaining a bank loan to purchase capital items. Legal cost in relation to tax appeal. Legal cost in relation to breach of contract. So the legal costs can be classified that way, the ones which are allowable and others which are disallowable. That's important point. Another thing that maybe I can mention briefly is taxable business incomes. Since we have seen this portion becomes very critical if you want to understand how to tax a business. Understand the expenses. Expenses can either be allowable. Expenses can either be allowable or disallowable. Understand that list. Which expenses in business are allowable and which ones are disallowable. Again, business incomes now can either be taxable or non-taxable. I just give you a few. Taxable business incomes. One is profit from business. Number two is realized foreign exchange gain. Another taxable business income is trading receipts and balancing charge. I've told you the meaning of a trading receipt and a balancing charge. Another taxable business income is the amount of trade bad debts recovered which were previously allowed when written off. Another taxable business income is insurance claims received in relation to revenue, e.g., loss of stock, decrease in specific provision for bad debts, etc. These are some examples of taxable business incomes. Then the other part is non-taxable business incomes. One is capital receipts, e.g., sale of fixed assets, income from foreign investments, additional capital introduced by owners or partners, and realized foreign exchange gain. So those are some examples of non-taxable business incomes. So incomes can either be taxable business income or non-taxable business income. So those are important points. Now, because this chapter 1 of advanced taxation, we are specifically dealing with taxation of a partnership. A partnership business is not taxed from operations, but it's the individuals, partners, the individual partners, who are taxed on their share of profit plus other incomes. So in taxing a partnership, we should take the profit share from that business, we calculate the profit for that particular business, then we share according to the profit and loss sharing ratio. Then once you share that what the partner gets is an income to that partner. Then what are you supposed to do with that particular share? You aggregate it with other sources of income for these particular partners, like farming income, rental income, and other income. And then you tax that particular amount. You as if you are taxing an individual. You can use a graduated scale rate. Some steps that you should follow when taxing a partnership is that the first step is to determine the adjusted income of the partnership in the normal way, that is, just like any other business, except that the following items will be disallowable. So these items, whenever you are taxing a partnership, will be disallowable. I've told you what disallowable expenses are. One, salaries and wages to partners, but salaries and wages to employees are allowable. We have said that if an expense is helping to generate the profit which is being taxed, then that expense should be allowable. But all private expenditure should be disallowable. So if their salary is going to the partners, then partners are the owners of this business. So that is like a private expenditure. So, but how will that amount be taxed? Because that salary to the partner is an income to the partner. So when you are taxing this particular partner as an individual, that salary to the partner will be part of the income. So it will be taxed that way. So salaries and wages to partners is disallowable. Remember, I'm saying step one, you determine the adjusted income of the partnership in the normal way. That is, just like any other business, except that the following items will be disallowable. Salaries and wages to partners, interest to partners, i.e., interest on capital, interest paid by partners, drawings of commodities are entered back at cost. Allocate, that is step number two. Step number two. Step number one, I have said, you determine the adjusted income of the partnership in the normal way, i.e., just like any other business, except that the following items will be disallowable. That was step one. Then step number two, you allocate income adjusted to the partners by first isolating salary to the partners, interest on capital, bonus to the partners, and commission to the partners. Those are the steps that you follow when you are taxing the partnership. Now, the next thing that I will show you is how to prepare the partners distribution schedule. But important things to note here, when you are taxing a partnership, always ensure that the accounts are prepared in accordance with the generally accepted accounting principles, that is GAAPs, i.e., there should be no over or undervaluation of expenses. So make sure expenses are not overvalued or undervalued. Incomes should not be overvalued or undervalued. Even the stocks, the closing stocks and the opening stocks should neither be overstated or understated. Then sales and purchases figures should be stated exclusive of VAT. That is very important. So if you are told that the expenses and the sales are inclusive of VAT, then make sure you exclude the VAT. So sales and purchases figures should be stated exclusive of VAT. Now, once you have known that particular part, which I have discussed with you, now the taxation of partnership now becomes very easy, and taxation of any other and other business. So I think you are able to see what is happening here. So I've told you that to conclude now the lesson, I've told you that if that is chapter one, what we are going to is chapter one, and you have to move a little bit faster because taxation is not does not have a lot of work. Chapter one, I've told you the secret here, or what is found here in chapter one, advanced financial, not financial reporting, but advanced taxation. Chapter one is partnership taxation of business income and specialized business activities, and you started with a partnership business. So that you are required here to understand taxation of a partnership where there is admission of a new partner and retiring partners during the year. So use admission of a new partner. By the start of the year, there were two partners, but within the course of the year, one more partner was admitted. Obviously, whenever there is admission of a new partner, there must be certain changes here, like changes in uh, profit and loss sharing ratios. Make appropriate changes. Retirement of a partner. You start the year when you have four partners. Within the course of the year, one partner retires or passes away. So you can see by the second portion of the year, we are less because one partner has passed away or one of the partners has retired. So you must show that exactly the first period when we were four and the last portion of the year when we were three or something like that. So when you are preparing these books, always try to show sort of columns. You'll be doing it in columnar form, columns. First period and the second period. Maybe when we were three of us, and then the other part of the year when we were maybe two of us or we were four. You show that. The other situation may arise where there is conversion of partnerships into liability company. We started the year when we were a partnership. Then within the course of the year, we changed this business from partnership to a company. So part of the year, we show our operations as a partnership, and the remaining part of the year, we show part of the performance of the business as a company. So you have to show that. So admission of a new partner and retiring partners during the year, then conversion of a partnership into liability companies, then incomplete records pertaining to partnership business. That becomes very important. That is what you'll be studying in chapter one. So what we have done, I think, up to that level is the foundation. I've given you the foundation of understanding the taxation of a partnership. So most of what you have done here is upon you to go through the basics of taxing of the theory of the taxation of a partnership, so that when you start doing the calculations, you be you not be maybe you are confused, why are we doing this and we are not doing that. So I've told you the first thing: understand according to the Income Tax Act. Take all the expenses and try to analyze them by either uh, expenses which are allowable and expenses which are disallowable. Then take the incomes, analyze them in terms of the ones which are taxable and those incomes which are non-taxable. That's the basic thing, the starting point for you to understand taxation of a business. That's the first thing. So once you have known that, the first thing is to understand that whenever you are taxing a business, you are always given, you can either use rather direct method or indirect method. The, the indirect method means that the accountant has prepared the accounting profit. Now, when he was preparing this accounting profit, obviously, what does it mean? When he was preparing the accounting profit, what does it mean? It means that he got the sales minus cost of sales, he entered other incomes or other incomes, then he deducted all the expenses. So what will you do when you, for the purpose of taxation? Take the accounting profit or the reported accounting profit you earn the bank all the disallowable expenses, and then you less what? Non-taxable income, and therefore you get your taxable what? Total taxable income if you are using the indirect method. And then the other is the direct method. And this one mostly involves situations where there are incomplete records. And I've shown you how to go about the incomplete records. Now, the last thing that you may maybe look at is how to prepare the partners distribution schedule. Now, the partners distribution schedule, I'll do it the next lesson when we are doing a calculation. So next lesson, we will do a calculation, but I think before next lesson, make sure you have gone through all the notes concerning allowable expenses, disallowable expenses, taxable incomes, and non-taxable incomes. Now, if you have any challenge, you have any, now there's a book here. If you have any challenge with what you are doing, you can see this book here. This is a good book. If you don't, if you have a challenge with your taxation, whether you have a challenge with your taxation, there's a book there. Now, this is used by CFA students. It's the same book that is used by CPA students. You can get it from us. I'll give you my number by the end in a few minutes. So this is a good book which contains many calculations. It also has the Income Tax Act showing the expenses which are allowable, the ones which are disallowable, and incomes which are taxable, and incomes which are non-taxable. So that is our theory part. And as I told you, as we continue with our classes, I requested you to be part of us, to be following what we are doing, so that before you sit the examination, we finish the syllabus as early as possible. So just be part of us. You can just go to our YouTube, you just join us, so that whenever we have a class and we post a video in our YouTube, that is Fatima Institute, you should be able to see what lessons that we have done. So we are going to finish up with chapter 1 about taxation of partnership businesses. The next two lessons, we'll take an example, calculations. So I want us to take some examples whereby we have a situation where there was retirement of a partner or admission of a new partner within the course of the year. That is a partnership business whereby there were two partners from January to maybe June. Then from July, there was one more partner admitted. So that half of the year, there were two, and half of the year, there were three. How do we prepare those books? How do we tax that kind of a business? Then the other situation, I would love another question whereby we started a partnership by January, or by January it was a partnership, but say for example, by September, we converted the partnership into a company. I will have that kind of a question. And I will prefer situations where our business is whereby we are using incomplete records. That will be very important for us. So those are the questions that I will be taking with you next lesson. So again, so you can have as via the number is there. The number is there. You are following us from where? Out of the country. Which country or which continent? Now you are following us from outside the country. Start with plus 254. Plus 254 is the code for Kenya. Plus 254. You are within the country. 0. 0727 0727 87 10 93. This is Mr. William. This is Mr. William. That is Mr. William. So make a comment there and you like the video. Make a comment and you like the video. And then you tell us where we need to improve. So just be following with the taxation. Even if you are in a different school or you are studying for yourself, compare what you are doing with what you know to be of much help to you. So we start the taxation. We are through with the theory. The theory, we are okay with the theory. I've told you the most important things to do with the theory. The starting point. If you want to be perfect with the taxation of a business, any business, the starting point is know any business has expenses, and these expenses can either be allowable or disallowable. Have a list of them, all allowable expenses and disallowable expenses. The other thing, all businesses have different incomes. Classify these incomes as either taxable incomes or non-taxable incomes. That's the starting point. And then understand how to prepare incomplete records and then how to prepare a partnership or partners distribution schedule that I will show you when we are doing the calculations. So we finish up the chapter 1 within the next 2 lessons, and then we move to chapter 2, taxation of companies, different types of companies. And this kind of question has to be tested always. It's always there. If you are able to tax a partnership, then you don't have any challenge with taxation of any other type of business. Because it will be quite easier to tax a company as compared with the taxation of a partnership. So that's enough for today. I think the advanced financial reporting, there are those who are asking about advanced financial reporting, how far we have gone. So you just get our videos in the YouTube, the ones that you have in the YouTube. You just get our progress. Our progress is in the YouTube. We are through with leasing, and then we are moving to deferred taxes. Someone was asking that question. So we are moving to deferred taxes. That is IAS 12. We have done IFRS 16. So you can just get what our progress in advanced financial reporting from YouTube, maybe tomorrow or the day after tomorrow. But we are moving to deferred taxes. That's somebody was asking that question. So that's enough for that. So we have the next class tomorrow. Thank you.